So today we're going to talk about bridge loans. These are incredible resource and incredible financing option for clients that are out there on the buy side, being able to put together a competitive offer, really free of contingencies. And those of you that are real estate agents that are working with buyers, you know, today we are dealing with a very competitive market, and often the most competitive offer is going to win, and the most competitive offer is an offer free of contingency. And so how do you really work with your buyer to give them the best advantage out there? And bridge loans is a really great solution for those of your buyers that have equity in property that they can access. And Danielle's going to explain her specific product. Know that Danielle is one of our private investors. She works in the, she also owns a processing company, and they have a brokerage, but she also has been carving out a niche in private lending that is a perfect fit for real estate agents. Let me go ahead and add everybody in. And just bridge loans are available across the nation. They'll vary a little bit from market to market and lender to lender on how they work. Danielle's going to cover how she works. She lives here in California. So if you're in California, this is where I would be sending my bridge loans to most of the time. And she's got a wealth of knowledge. I love being able to work with her because beyond this, all the knowledge and the experience that she has, she is very caring, and she took time out of her schedule. Really, like, our monies aren't really tied to one another. So her taking time out of her schedule to really educate me was a big deal. And so really knowing that she has a huge heart, and she's been so far a ton of fun to work with. So I'm excited for her to share exactly how you can use bridge loans to increase your business and win those offers. So Danielle, the floor is yours.
Absolutely. Thank you. Thank you. Yeah. So, I mean, I've been in mortgages since 1999. So I've seen all of the rounds of, market shifts and things like that. And do have a little bit of a unique, perspective, having both sides of the industry. A lot of private lenders know just private money, but we're very much on the conventional side too. And so we get to kind of see it all. And last year, I really saw the market start shifting, where our clients who, had a contingent offer to make, they needed to sell a house in order to buy a house, were really struggling and having a very challenging time getting their offers accepted. And it just was not feasible for all clients to use some of the more conventional bridge loan programs that are on the market. So there are definitely like institutional bridge loans out there, and Paige has access to all of those. So we're not going to really touch on those today. So I don't want you to think that the guidelines that I'm going to state are exclusive to all bridge loans, because there are more expanded criteria loans. But for the most part, they go through more traditional means. So a bank with an underwriting department and those kind of things. And it didn't always work for all clients to, have to qualify for both housing payments and those kind of things. So what we did was establish some private money sources so that we could offer a really fast and easy solution to our clients who had lots of equity. So essentially what we do is, if a client has, and they do need to have a good amount of equity, I'll give you the math on it in a little bit, but this doesn't work if they have, 20% equity in their house. They really need to have a good chunk of equity in their house. They've owned it for a long time, or they put a huge amount down, or it's appreciated a ton. And so those clients who want to go buy a new house, but are stuck in that in between, right? They don't want to sell their house because they're afraid that they're not going to go find something else. And it's really hard to sell a house when you're living in it. I have 4 kids and 4 dogs, and I can't even imagine trying to put my house on the market with me in it. And so this allows them to leverage the equity that they have in their existing home in order to buy their new dream home first. And it allows them to compete with the cash buyers in the market. I'm in the San Francisco Bay Area. There are lots of cash buyers. I don't know where they're all coming from, but they've got lots of money and they're coming in and swooping things up. And this allows our buyers, who would normally be at like the lower ring of making their offer stand out, right? Somebody who's contingent on selling another house with a low down payment, this pushes them to the top of the stack and really allows them to compete on an equal playing field to those cash buyers. So as a private investor, we step in and we provide normally 100% financing for their new purchase. So they can literally buy the new purchase without coming in with any cash to the transaction. Now we are securing a loan against both houses, and that's why we can give them 100% financing. So this is not like, you know, the 2005 days where we're giving out crazy loans. These are actually very safe from a security standpoint because there's lots of equity in both houses. So we step in, we allow them to buy their new house all cash. We can do these as a minimum 10-day closing. Usually 14 is a better timeline. 10 days is the required minimum because there are some disclosure wait periods that are required by law that, you know, if it falls on a Friday or there's a holiday, 10 days becomes very tight. But 14 days is normally kind of our standard, you know, give everybody a little bit of breathing room, come in and close as an all cash transaction. So no underwriting, no appraisals, no loan contingencies, no hoops to jump through. Really, the only requirements that we have as the private investor is one, plenty of equity in the houses, and I'll give you the math. And two, we need title reports on both properties. So that is normally the only thing that even slows the process down, is if there's an out of county title report or something, and that takes an extra day or two. But generally speaking, the process goes, you know, we get an accepted contract, we have disclosures out, closing disclosures out, all within a matter of days. And then we're just waiting for those required wait days in order to issue our loan documents, because there are some governmental wait periods on that. A lot of private money investors will not work on homes that are owner occupied. The laws are a little bit differently and the licensing is a little bit different. And these investors that I work with do allow for owner occupied transactions so that somebody can really truly buy their own dream home. We still do the non-owner occupied regular kind of investment, private money investment loans. But these have a very unique niche in the market because there's not a ton of private investors that are willing to do them because of the extra disclosure wait periods and because of the extra licensing requirements on them. So here's some math, right? And I'm going to give you a very general, you know, couple of scenarios of math so that you know the formula and so that you have a real life example. So for example, I just closed one in the last month or so. A little retiree who, you know, had lived in San Francisco for 40 years, something ridiculous. She had owned her home. It was worth about $2 million and she only owed about $100,000 on it. She wanted to downsize. She was ready to be done with her, you know, forever home and move into kind of her second phase home. And she wanted to move up to the Windsor area and prices were a little bit cheaper. So she wanted to buy a $900,000 house. So we were actually able to give her a loan amount of 1.1. So she was able to buy her $900,000 house and get a check at closing for a couple $100,000. What that allowed her to do was to go fix up her San Francisco house and get it ready to sell for top dollar. You know, gave her the assets that she needed in order to move and relocate. She was on a fixed Social Security income and you know, that would have been challenging for her in any other situation. One, just to like up and move, right? There's a lot of expenses that go along with that. And two, getting her house ready so that she could market it for getting top dollar. And three, that 900,000 price point in the market she was bidding in is very, very competitive. Having it be subject to selling her San Francisco property would have been almost impossible to get approved. And so this allowed her to be an all cash buyer and step in with a quick close and, you know, really solved all of her problems. So that's one scenario, is when somebody has a ton of equity in her house and at the end of the day, she will have no loan, right? So at the end of the day, she has whatever that is, 1.9 million in her current San Francisco house, and she's only going to get a loan for 1.1. So she's going to have some cash at the end of the day. She's going to pay off the bridge loan and she's going to be done. She's going to happily retire in her new home. No mortgage debt. That's one scenario. Another scenario that happens is you have somebody who, you know, has a good chunk of equity in their current home, but they will be getting a mortgage at the end of the day, but they don't qualify for both mortgage payments. So it's not possible, or they don't have the down payment in order to put like 10% down on a new home. And so they just need the kind of in between phase of things. So in that situation, we would give them the entire purchase price. We can roll in any of the fees and costs, which I'll talk about those amounts. But we would structure them for a future refinance. And so that's where Paige would step in and make sure that at the end of the day, they can get their permanent financing in place for wherever they want it to be. Not everybody's going to pay off the bridge loan in full with the sale of their house. Not everybody's downsizing. Some people are upsizing. And so Paige would get them pre-approved for their future refinance and make sure that they have that structured and they'll qualify and they can do everything that they want to do. We would close on the bridge loan. So they would purchase the house as all cash with their private investor financing. We would secure a loan against both properties. They would sell their current property. A good chunk of the bridge would be paid off and the remainder would be left on their new house so that she can refinance it and put it into permanent financing. And that is the more common scenario. You know, not everybody has like a completely free and clear property, but they do have that in between gap situation. The most unlikely case that we do see every now and then is someone wants to, you know, utilize the equity in their current house and they do have a ton of equity, but they qualify to do both loans simultaneously and they don't want to do a bridge for the full purchase price. Let's say the purchase price is, you know, $1 million. They don't want to borrow $1 million because that can get expensive. So they want to get traditional financing in place for their purchase, just like they would any normal loan, but they don't want to make it contingent on selling their current house and they have enough income to qualify for both properties. If there's a good amount of equity in their existing property, we can step in with just a second mortgage financing on their existing property in order to give them the down payment. And so then they can still get a regular loan. Now those don't move, you know, at 10 days, right? Those are regular conventional turn times, but just like any other transaction, those are still getting approved and can still let them leverage. This allows them to borrow a smaller amount on private money because they're borrowing just their down payment, but there's a little bit more strict rules on how much equity they need to have, and they need to qualify for both conventional mortgage financing. The private financing does not have any requirements for credit scores. It doesn't have any requirements for income. There's no debt to income ratios. We don't collect income documentation. It is based solely on the equity in both of their properties. And so the maximum that we will do is generally 70%. And so what that would look like, let's say you had a house for, you know, $900,000 that you currently owned and you wanted to buy a $1.2 million house. You would add up your totals. So we're at 2.1 million. You would take 70% of that. And then you would subtract whatever they currently owe in their existing house. So if their existing house had a, you know, $100,000 loan on it, we would have 1.3 available. So they would be able to finance their entire purchase price of their new house. They'd be able to roll in the costs and things like that without having to come in with any cash. Occasionally, they don't have enough equity to completely do the purchase price. And so we can do a combination of that, right? They can come in with a small down payment, but still utilize the bridge financing in order to close quickly and not have to qualify for both payments. In terms of the down payment on the bridge side of things, that can be any source. So it can be gift funds from a family member. Sometimes mom and dad can, you know, kick down some money, but not the whole thing. And so we can combine those things. We don't particularly care like a conventional loan cares about where the down payment's going to come from, as long as it shows up to the transaction and our loans are capped at our loan to value requirements. And that is generally the whole deal. Oh, let me talk about fees, because that's an important aspect of it. That's normally the first question we get, right? Now, what does it cost? And they are designed to be short-term loans. So our private investors know that you are going to get rid of this financing as quickly as possible. And there is a cost to using somebody else's money for a transaction. Generally speaking, you're looking at 1.5% to 2.5% in fees as upfront transactions. So if you're looking at $1 million, that's $15,000 to $25,000 in upfront fees in order to close the loan. Interest rates are generally between 7 and 8.5%, depending on what lien position and those kind of things. And they are designed to be 12-month terms. So they make interest only payments while they have the loan in place. And then they pay it off with either the bridge or the refinance or whatever combination of the two. We can build up the loan amount in order to give them the payments for that interest only period for a couple of months, which we generally do if somebody can't handle the extra, mortgage expense. This is in addition to whatever they currently owe on their house. So they would continue making their normal mortgage payments as well. Here's what I tell clients to remember on bridge expenses, because and we're not always dealing with $1 million loans, right? Sometimes we're dealing with $400,000 purchase prices or $500,000 purchase prices. I use the million because I'm in the San Francisco Bay Area, and that's where we're at on everything. But when you're talking about, let's say 2% in upfront costs, it can feel expensive when you're looking at it as a fee to close the transaction. Here's what you need to consider. One, you're getting to compete with all cash offers. So will you get to be more aggressive on your purchase price by being able to be an all cash buyer as opposed to a contingent offer? If you were contingent, would you have to overbid a little bit extra in order to win the deal? Perhaps, probably, at least in my market, that's true. And so generally some of those fees are intangibly recaptured by means of being able to be a little bit more aggressive on your purchase offer. You also get to be more strategic about selling your house, right? So you get to get out of your property, you get to clean it up, you get to paint, you get to stage it. How much more will you be able to sell your home for, if you can properly stage it and put it up for sale without having to be in the property while you're selling it? So some of the fees kind of get recaptured. And when you look at the other solutions that are out in the market, there are things like the iBuyer program, we'll guarantee that we buy your house if yours doesn't sell, or we'll guarantee that we'll buy that new house for you and you can buy it back from us. All those kind of offers. There's lots of different companies that are offering those in this market. Those are costing 2.75 to 3.5%, sometimes 4% in the purchase price, and ours is only on the loan amount just to complete those programs. And they have all the hoops that you have to jump through. They have their appraisal requirements, they have their evaluations, they have their inspections. There's all these extra rules. So it's one of those things that in this market you might have to pay 2% more for a property in order to be successful at winning the bid. But some of the costs get kind of intangibly recaptured in other ways by being a little bit more aggressive all the way around.
Yeah, and time. Right?
Yes, time is a huge factor. Being able to be a 12-day close as opposed to a 30-day close is a just different ballgame.
And your borrowers, that they can get their offer accepted in a matter of weeks, maybe, with this strategy versus
Absolutely.
I know some clients that have been shopping for homes for 6 months, and
Right.
How much did they lose in equity and now interest rate just
Right.
because they couldn't put in a non-contingent offer? They
Yes.
would well have made up any costs and fees that it would have cost them.
Yes, and that's a big reason why loan officers refer this program is, especially as interest rates are rising, they want to take that buyer who's going to be sitting on the market for 9 months trying to get an offer accepted, shopping for houses, and push it into a short window so that they can lock in that refinance and permanent financing as quickly as possible.
Yeah, another demographic, if you guys are trying to think of like what clients would this be a really good fit for, you might even have clients that they do have the money somewhere. However, maybe they don't want to pull it out of the stock market because we're going to hit a huge penalty to do so, or we got to pay cap gains, or there's a lot of different reasons why people may not want to access that money. They would like to access somebody else's money.
Yes, it's actually, we do have a lot of clients who utilize this program who have lots of money, and they understand that their money is going to make more for them staying to work than it will cost them to do short-term financing. We sometimes use a combination, right? If somebody has a huge account that they can put a margin loan on for a cheap amount, maybe we give a bridge loan for a portion and they pull a margin loan for the difference so that they're not taking their money out of the market and can still accomplish all of their goals.
So we'll open it up real quick. If you guys have any questions, you can unmute yourself. You can also type them in the chat box and we will answer them. I will say this, Danielle currently is only lending in California. I don't know if there's plans to expand to some of the other states that she's licensed in.
So we have two phases of this, right? One is I'm working with an outside investor. He's strictly California. We do have our own fund of money that we're building and pooling, and we are cautiously doing exceptions out of state for the right transaction. So like I do have one going in Georgia right now because it's small and it's something we can fund ourselves. So if there's the right transaction, I don't, hesitate. We can still try, but it's not as guaranteed.
Yeah.
It's
Okay.
case by case.
And over time, as that fund starts to grow, I'm sure more lending opportunities will become available. And not to say, like we did mention at the beginning, bridge loans are available, nationwide, and they're just going to change a little bit. Danielle's program just is really like simple and easy and quick.
I'm not the, I would love to say I'm super special. I'm not the only private investor who has put together this program, right? I'm sure there are private investors throughout the country that are willing to fund these kind of transactions, right? So
I have a quick question.
Yeah.
So, we're talking about 7 and 8% interest rates now, but in theory, we're going to be looking at 7 and 8% interest rates on 30-year fix inside of the next 60 to 180 days.
Yeah.
So will these private money rates kind of climb with this, or?
Hard to say, right? I can tell you they haven't. They've actually decreased a little bit. There's a little bit more competition in the market, and they're able to, turn them pretty quickly. So
yeah,
I don't see any huge movements to interest rates. Normally, the interest rate is most affected by loan to value. Yeah. So if
on loans that are only, on a loan that's held for less than 6 months or less, the interest rate doesn't really mean anything.
These are, yeah, exactly. Generally speaking, people keep these for under 2 months. Yeah. And they're churning them very quickly.
Good.
Oh, anybody else have any questions? And if you guys missed any portion of this, we did record it. I'll pull it down from the cloud and edit it, put it up maybe on YouTube or whatever, so you guys can watch a replay. Any other questions that you guys might have?
Says, what I have to tell you is, in this market, as things are getting more competitive and more competitive and more competitive, it is critical that we stand out and we solve problems. And this solves a huge problem for clients who, are afraid to list their home because they're afraid they won't be able to find a new house. They're afraid to, buy a house because same thing, they're afraid their house won't sell if they're living in it. Like all these kind of in between people, and we have an inventory issue. And so this allows, I have a lot of real estate agents that pitch it at their listing presentations. Like, hey, I've got a solution for you that's different, that maybe other people aren't talking about, so that you can not only like solve their immediate problem, but win the client, right? Because you're giving them an option that other people are not proposing to them. Everybody's saying, I'll get you top dollar for your house. But how are you solving this?
It's not really hard right now, by the way. Get you top dollar for your house.
Yeah, exactly.
It's just the market.
Yeah, just fielding all the ridiculous amounts of offers. That is the insanity.
That is a great way to stand out.